Bonds. So stocks, mutual funds, and ETFs are still too risky for you. Then you may want to entertain investing in a bond. For those that do not know, a bond is a loan from an investor to a borrower where that borrower pays interest on such loan. Bonds are sold for the fixed term, typically from 1 to 30 years. A bond's interest rate is fixed at the time of the bond purchase, and interest is paid for the life of the bond on a regular basis, be it monthly, quarterly, semi-annually, or annually, after which the full original investment is paid back. Now, you can sell a bond on the secondary market before it matures, but you run the risk of not making back your money on the original investment or principal. However, if you sell a bond when the interest rates are lower than what they were when you purchased it, you may be able to make a profit. But if you sell that bond when the interest rates are higher than what you purchased it for, you may take a loss. The three types of common bonds are U.S. Treasury, corporate, and then municipal. Let's now discuss the pros and the cons of bonds. The pros of buying a bond are they're a relatively safe investment. They provide a fixed form of income and they have potential tax breaks. Now, the cons of buying bonds are they generally provide a low return on investment and you can still lose money on bonds even though they are low risk, and then you have the periods of high inflation, the bond gets devalued. Some other noteworthy items are a bond's interest rate is tied to the issuer's creditworthiness. Moody's, Standard & Poor's, and Fitch are the three major ratings agencies for bonds. High-risk bonds are considered junk bonds. You can also resell your bond before its maturation date. Bonds lose value when interest rates rise, gain value when interest rates decrease. And high-risk bonds have higher interest rates. Low-risk bonds have lower interest rates. So, if you're interested in investing in bonds, you should get an understanding of the following chart, which we will show you, which will give you a breakdown of how each major ratings agency rates bonds. Once you understand these, you can then go ahead and make an educated decision on the risk of investing in a potential bond.